Welcome to the deep dive. You know, for decades, the investing world, it's chased gurus, hot tips, always hoping for that market edge.
Right, that elusive edge.
But what if the real path to wealth was actually about doing less, not more? Seems counterintuitive.
It really does.
So today, we're unpacking the radically simple yet profoundly effective philosophy of passive investing. Think John C. Bogle, the Bogleheads community. Our mission here is to reveal what this approach truly means for you.
And what's truly fascinating, I think, is how often the simplest ideas, they just work. They're the most resilient.
Okay.
Passive investing is not about chasing the next Amazon or, the next big thing. It's fundamentally about owning the market itself.
Owning the market. So instead of picking winners.
Exactly. You buy a little bit of everything. You embrace that broad diversification almost automatically.
Okay, so if the goal is owning the market, our sources talk about this key difference, right? Alpha versus beta.
Ah, yes.
Yeah.
Crucial distinction.
Beta being like the market's return, the tide, lifting all boats, no active steering needed.
Precisely. It's the market's inherent performance. And alpha, that's the extra bit. The return a fund manager tries to generate by, actively steering, picking stocks, timing things.
Tries being the operative word there.
Well, yeah. The data is not just clear, it's stark. Study after study shows, year after year, something like over 90% of active funds, they failed to beat their benchmark.
90%, wow.
Over the long term, yes. It highlights a core Boglehead idea. The real fight isn't against the market, it's against, ourselves. And the fees we pay trying to beat it. Which really makes you ask, why chase something so difficult, so expensive, when you can reliably capture the market's growth, with far less stress, too?
That's a really powerful question, especially when, all the financial news is screaming about finding an edge. It feels like a big mental hurdle to just do less.
It is. It requires a shift in mindset.
So the Bogleheads approach, it boils everything down to being sensible, not chasing genius. What does sensible really look like here?
Sensible means a sleep well at night strategy. Trusting the market's long-term upward trend, generally speaking, and avoiding those costly mistakes driven by fear or greed. Speculation, basically.
Okay.
A perfect example, the 3-fund portfolio. Super simple.
Right, I've heard of this.
It's just 3 low-cost index funds, or ETFs, which work similarly. One for the total U.S. stock market.
Got it.
One for the total international stock market, and one for the total U.S. bond market. That's it.
Just 3.
Just 3. By holding those, you're instantly diversified. Thousands of companies, governments. It naturally lowers your risk without needing a PhD in finance.
And the low-cost aspect you mentioned, that seems absolutely central. Bogle was famous for that, wasn't he?
Absolutely foundational. In a world often dominated by high-fee active funds, these low-cost index funds and ETFs, they were a game changer.
But couldn't someone argue you get what you pay for, maybe some higher fees are worth it? Or is that just not the Boglehead view?
It's a fair point to raise, but the Boglehead philosophy, backed by a lot of data, is pretty firm. For most people, most of the time, fees are the single biggest controllable factor dragging down long-term returns.
Okay, so control what you can control.
Exactly. And beyond cost, the passive approach means less trading. Way less trading.
Avoiding the temptation to tinker.
Right. Every trade can trigger taxes, plus commissions can add up. So this buy and hold approach, it's also much more tax efficient over the long run.
Letting it grow without constantly incurring taxes makes sense.
It's really a shift from, say, speculation to discipline. It's about saving consistently, living within your means, investing regularly. Like clockwork.
Right.
Regardless of market noise.
Right.
It's definitely not a get-rich-quick scheme. It's maybe a get-rich-slow-but-sure strategy.
Get rich slow. I like that. It has that ring of sustainability. It almost reminds me of that story, maybe it's not true, but about the best performing accounts belonging to people who forgot they had them.
Yes. It speaks volumes about just staying the course, doesn't it? Letting compounding do its thing.
Absolutely. So let's boil it down for you, the listener. What does this all mean? The core ideas seem pretty clear. Invest early, invest often. Diversify broadly. That 3-fund portfolio is a great example. Keep your costs incredibly low. And maybe the hardest part, stay the course. Tune out the noise.
It sounds almost too simple, doesn't it? Too simple to possibly work in this complex financial world.
Yeah, it does feel that way sometimes.
But decades of data, real-world results, they really prove its power. So the choice really is yours. What kind of investor do you want to be? Someone chasing that elusive, difficult alpha against pretty tough odds? Or someone patiently, methodically capturing the market's beta with simplicity and discipline.
What a great way to frame it. A really insightful dive into, well, the power of patience, simplicity, and just trusting the market's long game.
Indeed.
Yeah.
And think about this. If Bogle suggested the stock market itself can be a distraction from the real business of investing,
Okay.
it makes you wonder, doesn't it? What other parts of our lives might benefit from a simpler, more disciplined, long-term view? Cutting out the noise there, too.
That's some real food for thought. Fantastic. We hope this deep dive has given you some valuable insights today.